Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Something to keep in mind, though, is the tighter you make the size of the spread, the lower the capital risk you are taking. So in this case, I used a 20-point spread, sit between 650 and 670, or between 790 and 810. If I had made that $10, I would definitely reduce the amount of credit collected, but I would also reduce the amount of capital that I would lay out for this trade. If you make it wider, you make it 50 points wider on each side, capital risk is definitely going to increase. So again, you need to balance all those things and how they speak to you and your personal situation, your skill level, your understanding level, current market conditions, and so on. Let's talk about the probabilities of the iron condor. When using the first standard deviation move as a guide to choosing your short strikes, the probability of the reward is high, okay? And that's what I was saying earlier. The probability calculator is saying that it's almost a 70% chance of being profitable or of making at least some portion of that 20% return number. Now remember, the flip side of that says there's a 30% chance of not being profitable, okay? And if you get too nervous within the trade and you exit before time based on whatever you need to do, then you need to do that. But be aware that that can also take away from the potential reward that you can earn. And as we've mentioned already several times, condors have multiple commissions. Let's see here. Okay, I see a question here from Francois. It says, why don't we use strikes at or just in the money to get a greater reward than the risk? And that is an excellent question, and that will be discussed when we do butterfly spreads. Butterfly spreads use at-the-money options, and it gives you a much more favorable risk-to-reward relationship. But as you will see, the probability will take a sharp decline in return. So again, it's all a three-way balancing act. Robert is asking about adjustments. We will not have time to get into that today. I just want to get into the basics of the condor and also theoretical, not theoretical, but practical application of what you're really looking for. But if you're interested, we have an excellent presentation at TradeKing.com. Go to TradeKing.webex.com, and we have an on-demand recording about iron condor adjustments. It's a two-part series, so please look for that for our on-demand recordings. And our speaker goes into some great examples of different adjustments you can use. Okay, to summarize here, the condor works best when the underlying is expected to be range-bound. That's, sideways movement, not much news going on, things are pretty quiet. The reward to the risk profile is typically low, okay? Because the focus is on the probability that you're going to actually make the reward. It's high, right? Because the probability of the success is high, typically the reward to the risk is low. The key to this trade is picking the short strikes that you think are going to give you the best chance of success, but also gives you a reward that is worth taking the risk. If things aren't going your way, you need to actively manage this trade. This is not something you just put it on and forget it. This is not the airplane spread, okay? You put it on and you go on vacation. That's not what this is. You need to manage the trade, be in touch with it every day at a minimum. Another thing to keep the risk down, though, is to keep the strikes narrow as possible on the on each spread on each side. As I mentioned already, the profit needs to be attractive versus the risk taken and commissions incurred. Another item here to mention is the bid-ask spread of the options you're trading. The wider that is, the more that will cut into the potential credit you're trying to collect, as well as increase the cost when you're trying to get out. So that's something to consider before placing a trade. Look at the vehicle, the underlying of your trades. Look at the open interest of those options. Look at the bid-ask spread of those options, and make sure that it's something that a place that you want to do business. That's how you should be looking at these things. If you have a gain in this trade, no need to wait till expiration, right? Take the money and go. Don't think that just because you can possibly earn 20% in this trade that you should hold out to make the full 20%. Some traders I know, if they make half of it, in a short period of time, they're gone, and they move on to the next trade. Remember that the sooner you close out your trades, even though you may not get as much as you think you should or as much as the maximum and so on, that still provides you the capital to make another trade and to turn it over quicker. And what that does is it gives you more opportunities, and in the end, that may work out much better for you. I don't want to go off on too much of a tangent, but it's not always thinking that, oh, you're just going to try and make that extra 10%, to go from 10% to 20% return. Not only are you risking the capital that you put up for the initial trade, but now you're also risking the 10% profit that you have by not getting out at that point. So that's always something to keep in mind. And finally, because this is a range-bound strategy, it's usually more popular to use with an index since it's less subject to crazy outcomes with news events and earnings or takeover rumors or what have you. So that's something to keep in mind. And obviously, if you're going to trade FX options, you need to be aware of the specific factors that can affect it. As Steve mentioned at the beginning, he said the Australian dollar was near all-time highs because of the interest rates being raised in that country. And if people want a better rate of return, they're going to go where interest rates are higher. So you need to be aware of the specific nuance of the underlying you're trading, whatever that underlying is. And these are some things to consider when trading FX options. And in summary, we've already covered all of these areas, but this is something that you can print out and keep handy. It's a little table of all the items we talked about and what the Condor gives you. And in our next discussion, I will give you a similar one for butterflies, and we will discuss the side-by-side comparison of how the trades differ. So that's all I have for today. I'm open for questions, of course, and please join us for Part 2, December 14th at 4:30, and we'll discuss butterflies and how it contrasts to today's presentation.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.